is David Scherer. I'm co-CEO and co-founder of Origin Investments. Welcome. I'm going to be covering how real estate in a volatile market can improve your portfolio. For those of you, and I think we have over 500 registrants on this morning, many of you are partners now, and you partner with us on, we've had 8 funds, 4 are funds you can invest in today, but we have 8 in total. So if you are a partner in an existing fund, you're seeing the benefits in real time. If you're a new investor, welcome. And we'll be making an argument today, a data-based argument on why real estate should be in your portfolio for the long term, both to increase the expected returns, but also to lower the standard deviation. And that's another way of saying lower the amount of the movement of your portfolio. And I'll explain why and some of the leaders in this thought over the last 30 years. I can tell you it's why I started investing in real estate in the late 90s. It's also why my partner and I, Michael Lepiscope, formed Origin in 2007 to protect and grow our own capital. And so we are big believers in this. A couple things. I'm going to try to save a ton of time for questions. I mean, one of the things we do, if you're new to these webinars, we do them on all of our funds on a quarterly basis. We do thought leadership. We try to have about the last 30 to 40% to live Q&A. There were a tremendous amount of questions sent in prior, so thank you for that. I'll try to cover maybe 30 or 40% of those questions because candidly, there's about 50 sent in. And then the rest will be live Q&A. I'll acknowledge you by your first name only, but we'll try to cover all of your questions. Most of the questions that I see this year are something around interest rates going up, inflation, construction costs, affordability ratios, asset valuations. These are all sort of the groupings that I get most often. So we'll focus a lot on that in the Q&A. So with that, let's get started and we'll start the presentation. Okay, so a little bit about Origin. I'm going to cover this quickly. We only invest in multifamily, and that's for a reason. Multifamily has been the highest returning and lowest risk real estate asset class, defined by standard deviation, how much it goes up and down in value over time for the last 30 years. So it's not an accident that we only invest in this. It's based on our research over a long period of time. It's all we do. So we have lots of different ways to invest as an investment partner in Origin, and I'll get to that at the end of the presentation, but all of them utilize one asset class, which is multifamily. Number two, we have offices throughout the country in the areas we invest, and we invest in 12 cities. I call it the Smile, but it's basically the Southeast, which includes Florida. It goes into Texas, and then it goes into the Southwest. And so these are warm, low tax states. They're lifestyle states. And with COVID in particular, sort of unlocking the workforce, a lot of people don't need to live in the Rust Belt, Midwest, the coast, which are higher cost. You see a tremendous population flow into these states. Importantly, we've been there with people living and working for the last 10 years. And so we have lots of deal flow, lots of knowledge, lots of infrastructure. We believe we're in the right places. So one of the things to think about, whatever fund you're interested in, if you don't believe that the Smile states will continue to be high growth, high return on investment states like they have been for the last 10 years, we're not the right firm. Like if you said, you know, I really want to invest in New York City, in San Francisco, and Cleveland, and Cincinnati, we're not your firm. You should find a different manager. We won't be investing in those areas. In terms of our returns, what I'm most proud of is this pre-Quinn ranking, top decile fund manager. Footnotes are overlooked a lot of the time. I think it's really important in this case. Number one, we weren't just top decile. We sort of round that down, we were top 3%. So we ranked 13 out of 173 global real estate managers. And what's most important is it's not for a particular fund. It's actually for all of our activity since 2014. So you're talking about, at this point, almost 8 years of data that straddles 4 to 5 funds. And so we're really proud of the consistency of our returns. Of course, our assets under management are growing. That will continue to grow. We had a record Q1. We were actually just ranked the second fastest fundraising in Q1 2022 in the country for one segment of real estate management. That just came out yesterday, which we're super proud of. But we have, it's all built on this high equity multiple, high average IRR. I think people are drawn to our alignment. In other words, my partner and I and our team, increasingly Origin's team, we heavily invest in our funds. So to date, 75 million has been invested by my partner and I, and increasingly our team. And so we're taking the same investment approach as you are, and we benefit when the investments do well. And then in terms of growth, we target one type of client, and that's a taxed investor. I'm a tax investor. My partner Michael's a tax investor. Every single one of our 2,700 clients is a tax investor. And the reason that's important is we're not just trying to produce risk-adjusted returns that are better than our competition. We're also trying to produce the best post-tax returns. And so you'll see this in a lot of our funds. When appropriate, we have subsidiary REITs. That reduces the dividend tax by 20%. These types of structures wouldn't be beneficial to you if you were a pension or an endowment and you don't pay taxes anyway, right? So we try not to mix tax and non-tax investors. Real estate's an incredibly tax efficient asset, and I'll get to that a little bit later in the presentation. Next slide, please. So let's jump right in. And before I get in, there's an awful lot of data on this page, but the big picture is this. In Q1 of this year, we've never seen in the last 5, 6, 10 years, really since the Great Recession, we've never seen a quarter as bad as this in terms of stock and bond returns. Stocks are on their lows this morning. They tried to rally but couldn't. So, the S&P is down almost 10%. The NASDAQ is down 20%. That's in one quarter. And at the same time, bonds, the risk-free rate, when we woke up on January 2nd, the risk-free rate, which I define as the 10-year note yield, was about 1.5%. I believe this morning it's 2.75%. So you have a situation where if you have a traditional stock and bond portfolio, you're losing anywhere from 10 to 15% on your stock, and you're losing anywhere from 7 to 10% on your bonds. In other words, they're not a hedge because rates are going up at the same time stock prices are going down. And in fact, stock prices are primarily going down because rates are going up. And the discount rate on stocks, essentially a stock is nothing more than the net present value of earnings into time. And as you raise the discount rate, the present value or the price of the stock today goes down at any constant earnings rate. And so that's just a long-winded way of saying asset prices go down as the risk-free rate goes up. And that's what we're seeing in Q1. So how do you hedge against that? The first thing you want to do is have things in your portfolio that don't move at the same pace in the same direction. That's the whole point of portfolio theory, is to have different assets and investments that don't correlate. You don't want perfect correlation in your portfolio. And so this slide is nothing more than looking at a really large time horizon. This is a 21-year time horizon. And it's important because if you think about that horizon, that straddles the internet bubble bursting. I was in the middle of that. The run up in the 90s, it burst in 2000. It straddles the Great Recession, huge stress test, 08 to 11. it straddles COVID, and now it's picking up on the normalization of Fed policy. In other words, unwinding their balance sheet and taking us off a zero risk-free rate world where they were supporting investment valuation with liquidity. They were buying bonds, they were buying risk assets, they were printing money, and now they're taking that off. And so you look at this long horizon, what you're looking at in investments, it's always the same. If you were a consultant or a pension manager, you're looking for the highest return with the lowest standard deviation, because standard deviation measures the movement of the investment over time, and more movement is worse, right? So if you have a stock that is $100 stock and it moves $15 every day, that's worse than having a $100 stock that moves $1 a day. And that's the standard deviation component of a portfolio. So over this horizon, the historical return, if you were in a typical portfolio that we see, 60% stock, 40% bonds, your historical return would have been 13.9%. Your standard deviation, 11.6%. Remember, a higher standard deviation is worse. And then the Sharpe ratio is nothing more than the relationship between the two. A higher Sharpe ratio is better because your return is the numerator and your denominator is the standard deviation. So the Sharpe ratio is 1.21. Over the same period, you would have had a significantly higher return, 15.5. The reason for that is we're reducing stock and bond with real estate, which has a much higher historical return than bonds. And you're also getting higher dividends through private real estate than bonds can provide. Because they're not as correlated, this portfolio, your standard deviation is actually lower. So that's kind of the gold standard. Whenever you're looking at subbing out an asset for something else, you want to see higher return and lower standard deviation. That's what's happened over this 21-year period. And that's why the Sharpe ratio is so much higher at 1.44%. The numbers on the left are just they're just a statistical representation of the difference between 1.21 and 1.44. So the Sharpe ratio is 19% higher. That's just 0.23 divided by 1.44. Same with the historical return. That's just the relationship between 13.9 and 15.5, et cetera. If you have any questions on this, we can cover it in the Q&A. Next slide, please. So here, this is going to look very similar, but it's actually only 2021 data. So we've taken a 21-year snapshot. Now we're going to look at 1 year. The reason I chose 1 year is 2021 was a very inflationary year. People didn't realize it. Even the Federal Reserve wouldn't acknowledge it. They kept saying words like transitory, right? It's transitory. Well, it's not transitory. Now they don't believe it's transitory. But we were in an inflationary environment all of last year. And in fact, the risk-free rate went up a lot last year. It went up from around 1% at the beginning of the year to 1.5% at the end of the year. So as a percentage move, that's extraordinarily high. And I believe, I can tell you from my standpoint, I saw in 2021 the price of goods going up, whether it was food, whether it was oil, whether it was the cost of education, whether it was medical. We have 40 people at Origin. I saw our medical plan go up significantly. So I saw inflation last year. I saw wage inflation, and we also saw asset inflation, whether it was stocks, real estate. Assets were inflating. So both at the asset level and the goods level, we were in an inflationary environment last year. The only difference was the Fed wasn't acknowledging it and wasn't reversing their policies in 2021. That happened this year. In terms of what happened, because this is really important, real estate performed amazingly well in 2021. And so if you look at this 1 year snapshot, last year stocks and bonds did very well still, because they were fueled by this asset appreciation that happened. That's now reversing. So their return in the 60-40 again was at 15.9. But if you had subbed out the 60/40 to a 50% stock, 30% bond, 20% real estate portfolio, you would have received an 18.5% return. The standard deviation is slightly lower, not significant, but slightly lower. But your Sharpe ratio is remarkably higher because you have a higher return and a lower standard deviation. And again, to have that big of a difference in the Sharpe ratio over a 1-year period is pretty remarkable. Why would real estate do so well? Because in an inflationary environment, rents go up. And that's exactly what happened. And in fact, if you think about the CPI index, that's the inflation index that everyone is focused on now. One of the biggest inputs into that index is the cost of housing. And the way housing is measured in that index is the cost of rent. And so I would tell you that CPI is going up, and a big reason for it is rents going up. Well, when rents go up, we make money, right? We own multifamily buildings that are now charging much higher rent. And that's an extraordinarily powerful thing that moves values our way. And so we saw and are seeing now the continuation of that, a very strong period of our assets appreciation. Next slide, please. So here I'm going to do this one last time. Now I'm going to just look at Q1. And so Q1 is where now the Fed is reversing its stance. They're talking about raising rates. They're talking about unwinding their balance sheet. They are raising rates, right? They did their first quarter. The market expects another half, and then another half behind that. Some of the Fed governors are talking about getting rates as high as 2.5% to 3%. And by the way, when I say rates, I'm talking about what they can control, which is the Fed discount rate and the very short end of the curve. The Fed can't control the 10-year note. That's market driven. Although they have influence over it, the market ultimately will decide that. But to be clear, when I say the Fed is raising rates, that's the very front end of the curve. It was at 0 last year. The expectation now is 2.5%. Maybe even higher by the end of this year. So that's a huge change in sentiment. So as you can imagine, the first quarter was very difficult. I can tell you that a 60/40 portfolio was down 5.1%. The standard deviation was 3.1%. There's been a continuation in April. So if I had done end of April, if we were doing this in the next week or so, the total return is actually even lower than that because yields have gone even higher, which there's a negative. When yields go higher, your bond portfolio loses money, and equities have gone lower. So I would say today it's probably more like down 7% for the year. And that's remarkable for a 60/40 portfolio to lose that much value in 3 to 4 months. But we're also in unprecedented times. We've never had a Fed balance sheet of $10 trillion, right? And I'm not suggesting the Fed did anything wrong. We were in COVID. They did what they had to do, but they're now unwinding this. And there's a lot of dislocation when you do that. So what happened if you subbed out and you were in a 50/30/20? You still would have lost money, but only 3.4%. The standard deviation actually goes down significantly, and your Sharpe ratio improves significantly here. These don't seem that high, like the difference between 5.1 and 3.4. You lost money in either place, but that's a 33% higher return, right? You saved a tremendous amount being in this diversified portfolio. Again, why does real estate do so well in inflation? Another way to think about this is a building, a multifamily building, is nothing more than an amalgamation of commodities, right? So what does it take to build a multifamily building? It takes concrete, it takes lumber, it takes copper. You have all these inputs that are now much, much higher than they were a year ago, but you already have them in your building. And so what that means is replacement cost has gone much, much higher. And so the only way you're going to have more competition is if rents go up, because no one's going to build something for a negative return. So now the only way more competition comes in is if rents go up. If rents go up, you're already winning, right? And the rents are going up significantly. They went up anywhere from 10 to 25% last year. They're going up anywhere from 8 to 10% this year, in some markets more. To give you some historical context, real estate rents usually go up 2.5 to 3%. So when they go up 15%, that's 5 times more than normal, right? And so that has a pretty powerful effect on the value of our assets. Next slide, please. So the idea of subbing out a stock and bond portfolio with a diversified investment strategy that doesn't have all assets correlating is not new. In fact, one of my mentors, he doesn't know this, is David Svensson, and he ran the Yale Endowment from I believe the mid 80s until about a year ago. Unfortunately, he passed away, but he revolutionized portfolio theory. And it was very simple. What he said was, look, you can't be in just stocks and bonds. You have to be in non-correlated assets. And he introduced real estate into the Yale portfolio in a significant way, but also other things, venture capital, private equity, commodities, foreign equities. And he's been largely emulated now for a reason. So on the right, if you look at what the Yale Endowment has done, they've just crushed all other endowments over the last, I mean, this is showing a 10-year period, but this could go all the way back to 1990. And they've redefined along the way how an endowment or a long-term investor should be positioning a portfolio. And I would tell you, most of us today don't have pensions. And so what I'm telling you is most of us today, either you have an investment advisor or you're doing it yourself. And in either case, if you have an investment advisor, you still need to actively manage that advisor. You need to have, it's too important. And if you're doing it yourself, it's too important. Like you have to be your own CIO, Chief Investment Officer. These things matter. And so I would recommend you read his books. They're very simple, actually. But when you get into alternatives, because he uses a lot of them, what he doesn't tell you is how to select a manager. Because when you're trying to pick a real estate manager or a private equity manager, it really matters who you pick. These are illiquid assets that you really need a skilled team and infrastructure and competitive advantages. And he did a really good job of manager selection. So we could do another webinar on this, but I've written extensively on how to select a manager. It's in our education section. Others at Origin have, I know Michael has as well. Please search those articles and read them, and it'll outline a process of how to select a manager. Whether you select us or not, you should use it as a resource. It will matter in your total returns and the risk you take, the management teams you select. Next slide, please. So the benefits of private multifamily real estate. Here, what's interesting is multifamily is in blue on the right, and you have stocks and bonds. Bonds, they've had 21 down periods in this very long period from 1998 to 2021. Multifamily's only had 7. That's interesting. Stocks have had the most. So what this is showing you again is number one, multifamily doesn't correlate in these up and down cycles, and that's good in your portfolio. You don't want everything to correlate. What's also interesting is if you look at stocks total returns, they've done quite well over a long period of time, but they've not done much better than multifamily. I mean, they kind of wind up in the same place. It's just multifamily was much less volatile. And in terms of total returns, bonds don't look very volatile, but look at the difference between the wealth created in multifamily and bonds, right? So again, this is if I'm looking at this graph, and I'm not suggesting you do this, but if you wanted the highest returning, lowest risk asset class, you would be not 20% in multifamily, you'd be 50%. I'm not suggesting you do that. That's not, probably responsible. But it is the highest historical returning, lowest risk asset class to get you to where you need in terms of growth over a very long period of time, relative to stocks and bonds. Next slide, please. We touched on this. Multifamily is a inflation hedge, and this for a couple of reasons. I talked about before, it's a basket of commodities. That's what these buildings are. So as commodity prices go up, the building you own and a replacement cost analysis is going up in value. I would argue that's one of the reasons residential real estate has been so strong over the last 15 months. It's not just low interest rates, it's the price to build keeps going up. And as the price to build keeps going up, existing housing is worth more. If you own a 5-year-old house, 10-year-old house, it's also going up for that reason. So here we have inflation, which you see that it's spiking up from essentially very, very low to 5%. Now it's more like 7 to 8. I would argue it's higher than that, but that's the reported measure. And then we have rent growth, which I talked about, and here you see, typical rent growth is sort of in that between 0 and 5%. I see it, I've been doing this quite a while. Typically, we underwrite to 2.5%, maybe 3% rent growth. Now we're looking more like 10 to 15% rent growth, and that's why we see the value of our assets going up. Is as rents go up. The analogy I would make is if you owned a stock, let's just pick one, Apple, and it's a very negative market sentiment. So tech stocks are going down, but Apple comes out with earnings and they're unbelievable earnings where they expected that they would earn. Apple is about $160 stock, so let's say they expected 10% earnings. So $16 a share, and instead they get 30% earnings, $50 a share. The price of that stock would go up because the earnings they're idiosyncratic and they're so powerful. That's what's happening in our portfolio is our earnings, our rents, they've gone up 3, 4, 5x, and that's because of inflation. And that's why it's a hedge. And so you see in the black multifamily returns, they continue to go up. And the returns are not just the cash flow we pull out of a building, they're also the value of the underlying asset. Asset values have gone up in Q1 of 2022, but free cash flow has too. That's because of inflation. Next slide, please. So here I just took one of our funds. This is our Origin Income Plus fund, and this is a multi-strat fund. Again, multi-strat, it's only multifamily, but it's multi-strategy in the sense that we both do direct development of multifamily. That's about 20% of the fund. We own existing multifamily and operate and run those buildings. And then we also invest in preferred equity, which is essentially a more protected capital investment that sits behind common equity. And there we target 12 to 14% returns, but they're capped. So if the deal does really, really well, we don't get 20%, we're capped at 14, and we don't get more than that. But these are, this is the combination of the dividend. Multifamily credit fund pays just under 6% annual dividend, and then the appreciation by month. And so this is starting with April 2021 and running through March. So this is sort of the trailing 12. It's returned 22%. Again, that's just another way of stating this is a very broad swath of real estate across all of our markets, 12 cities. some are development, some are core assets, some are prep positions, but it's a pretty broad investable set. $250 million fund in equity, so roughly 500-600 million in assets here. So it's a big grouping, and it's done very, very well in an inflationary environment. Next slide, please. One of the reasons the standard deviation is so much lower than stocks, because I'm really kind of focusing there. The total returns on stock and real estate have been similar. That's a few slides back over a long period of time. But I noted that the standard deviation or the volatility of stocks is much, much higher. And one of the reasons is stock dividends are so much lower than what you get in free cash out of private real estate. So here we're comparing one of our funds, Income Plus, 5.7% annual dividend, if you will, to investment grade bonds and US 10 treasuries. That's a little bit lower today, but this stuff moves quickly. I think the 10s are 275 this morning. So very, very close. If I then said, okay, what is the dividend on the S&P? We can all pull that up, but I would guess that it's somewhere around 2.5–3%, because in the S&P you have some high-paying dividend stocks, but you also have lots of growth stocks that don't provide dividend at all. So this is why one of the reasons I'll tell you our standard deviation is lower is private real estate has much higher dividends than most investments. The investments that would provide similar dividends, I would argue, are much riskier than a hard tangible asset like multifamily that's also an essential asset, right? You don't get to decide you don't need multifamily, you need a place to live. And that's the other thing that happens in a recession is a lot of these discretionary stocks or even discretionary real estate, like a hotel, you don't have to go to a hotel, right? Or a restaurant, that's real estate. Someone owns that building. You don't have to go to a restaurant, but you do have to live somewhere. And that's what you see again and again. When things get tough, people pay their rent. And that's why we're in that asset class. Next slide, please. The other benefits of real estate, which I think it's unique, is depreciation. Once we build or own assets, we can depreciate them. So you're essentially saying that they're going down in value on an accounting basis. That's what depreciation is, but it offsets dividends. So there's an awful lot of real estate that I've owned over the last 25 years. I can be getting a 6, 7, 8, 10% dividend cash, but I don't pay taxes because depreciation offsets it. That's really unique to real estate, and one of the reasons I think it's such a good long-term asset to own. You can refinance real estate, that's tax-free, right? So, and that's really back to we're taxed investors. What Origin is trying to do is create long-term funds for our investors where we can depreciate assets and offset dividends and refinance assets as they go up in value, because that's tax-free too. And you can actually do that in perpetuity. There's no reason to sell real estate and pay capital gains tax. In particular, if you were going to then take that money and reinvest it in real estate, because you're investing post-tax, right? So everything we do here is about protecting risk, protecting capital, growing capital, and then being tax efficient for us and our investors. Within real estate, you can also do 1031 exchanges. That's just a tax-free transfer from one asset to another. There's the QOZ tax program. It won't surprise you that we're one of the most active in this space because it's so tax efficient. And we have 2,700 taxed investors. So this is a really unique program. We're raising our second fund there. Our first fund was 275 million. The second will be 300 million. We're about half raised in the second fund. And again, in this program, you're going to not only get depreciation, but there's no catch up of the depreciation because there's no capital gain if you hold it for 10 years. So you get to depreciate and offset dividends, but then on top of that, you don't even have the catch up of the depreciation, it's just remarkable. And so I'm super excited about that program and heavily invested in it myself. And then on the right, I mentioned the idea of subsidiary REITs. We have that both on Income Plus and multifamily credit. And so essentially what that's doing is part of the 2017 tax bill was this special incentive for real estate, which provides a 20% reduction of dividends. Both of those funds provide large dividends. Again, all of our investors are taxed. So by attaching a subsidiary REIT, complying with that part of the law, will reduce that ordinary income tax rate from 37 to 29.6. And so if you're looking at any other fixed income investment, I don't care if it's a muni bond or a 10-year note or a corporate bond, you don't have this because it's not real estate. And so you'll pay 37, you won't pay 29. And so one of the things you should do, whether you have an investment advisor or you're doing it yourself, on any fixed income investment, is you should be looking at it as post-tax because you're going to pay ordinary income. And in our case, you're going to pay ordinary income minus 20%. So that's a pretty big difference. Next slide, please. So the tailwinds right now, if I look out, and we have to, these are long-term assets. One of the reasons I like multifamily as a long-term asset hold is there's a supply-demand imbalance. There haven't been enough multifamily units built. And it really started in the Great Recession, right? So if you think about what happened in the Great Recession, lending stopped and equity was scared. And so there was essentially a 3 to 4 year period that not many multifamily units were built. We've never caught up. And at the same time, because the labor force has become more mobile, and now increasingly, the substitute good for multifamily housing is housing you can buy. And what's happened, especially in our markets, meaning the Sunbelt markets, the low tax markets, the growing markets and population, they've really gone up in value, the residential homes. And now that interest rates are higher, people can't afford to buy homes, right? So what does a person do that can't afford to buy a home? They rent a home. And so, what I see happening with higher interest rates and now that housing is higher is you have a lot more renters that are going to need to stay renters until that paradigm switches or until wages catch up with appreciation of assets, which they haven't. The wages are going up for sure, but not as much as asset appreciation. It actually isn't even close. So I like the long-term outlook of demand for multifamily based on an undersupply, which started in the Great Recession and has never been cured. And you can see at the far right, apartment demand, and this is really reflective of COVID, has gone through the roof in 2021. And that's not surprising to me because I think the substitute good has become too expensive for a whole segment. Next slide, please. And this is just reflective of what happens when demand exceeds supply. You see rents go up, and we talked about that, and you see occupancies go up. Historically, occupancies are 94, 95%. They're more like 97. When they get that high, you also see rent increases. When I talk to our investment management teams at Origin, we don't want our properties to be at 98%. Because that tells you you're not raising rent enough. You want to be around 95, 96%. You want some people leaving because you can replace them with others that are willing to pay a higher rent. The notion that you want to be at 99, 100%, that's just not true. I would be upset if we were there. And so keep that in mind. Next slide, please. This is just an idea of our different funds that are currently available. Growth Fund 4 is a development fund for capital that is not capital gains in our target markets. QOZ Fund 2 is again a development fund, but it's for capital gains. So if you have capital gains, I would tell you should invest that money in QOZ 2 because you get all kinds of wonderful tax benefits for that. It's the same exact strategy, the same markets, the same developments. And some of our best assets are actually in QOZ Fund 2 in terms of development, what I think the expected value is. The reason the target net IRR is lower in QOZ Fund 2 is the whole period is 10, 11 years. The Growth Fund 4 is more like 4 or 5. So don't focus on IRR. There's a lot more wealth that's created by owning real estate over time than just getting a high IRR over a 4 or 5 year period. That's a mistake that, think about. I'll give you an example. It's incredible. When the LA Clippers were sold, I believe the owner's name was Sterling. He sold it to, I think it was Steve Ballmer. It was a Microsoft exec for just over $3 billion. And he had paid, I want to say $100 million for it in the early 80s, right? So 35-year-old when he sold. I just for fun did that math, and you can run it in Excel and back into what the IRR is. And what's shocking is how low it is. And when you compound for 35 years, I believe it wound up being 13%. It was a 13% return over 35 years compounded. Like, don't fall in love with IRR. I've written articles on this too. Like, you can go to the education section. You should fall in love with multiple and IRR over long periods of time because that's life-changing. Income Plus is our multi-strat fund. I mentioned that before, and Multifamily Credit is our lowest risk fund. Most of its return comes through dividends. There is a little bit of appreciation in that fund. Importantly, all of these funds are tax efficient, and all these funds are multifamily only an investment strategy, but some of them are higher risk than others, right? So the Growth Fund 4, it's a development fund. It's getting you more return. It's also higher risk than Multifamily Credit. That's our least risky fund. So we like to meet investors at their need. I can tell you that I'm personally invested heavily in all four because I like the dividends of Multifamily Credit. I like the multi-strat of Income Plus. Capital gains, when I have them, I love to put them into QOZ 2. And Growth Fund 4, I have non-QOZ or capital gain capital that I want in development. So I'm invested there as well. Okay, so before I go to Q&A, and I want to do a time check. Let's see here. It is 10:43. So I'll do 20 minutes of Q&A. I'm going to start with the emailed in questions. And if I don't get to your question, because there were, I want to say 4 dozen sent in, and you want it answered, you can email me directly, David@Origin Investments. I might answer it. I might send it to the person on the team that can answer it. We'll see. All right, I'm going to jump right in. So first question, but I think I haven't talked about interest rates and what we're doing about them. So there are a lot of questions about inflation and interest rates. So I'm going to try to tackle those. Interest rates are higher. The borrowing costs are higher. As I've been stressing, that's bad, right? I'd rather buy her cheaper than more expensive. Construction costs are going up. That's bad. We do a lot of construction. We mitigate it, but they're going up. But I can tell you this, all of those things are nowhere near as powerful as the rent growth we're getting. So I'll give you an example. This actually happened 2 weeks ago. We had a construction overage on a deal in Income Plus in Tampa Bay. Great site. We've been working on it for a year and a half. And it wound up being a 10% overage, which is quite large. And our head analyst, Jacob, who's the point on that deal, due diligence, he came in and shared it with me. And he said, there's this overage. And by the way, is there a way that Origin team members can fund the overage and participate in the investment and the equity here? So think about what's going on. The person that's most knowledgeable about the deal and the economics and the modeling of anyone in the world, he's doing it every single day. He walks in my office and essentially says, there's an overage and can me and my family fund it? I mean, that's essentially what's happening. And that's exactly what I'm talking about. When rents go up, that and significantly, I mean, in this case, you're talking about $1 million of NOI, net operating income or EBITDA, that's been created above what we modeled. And not only is that $1 million of free cash that we didn't model, there's a multiple on that at the terminal asset value of about 30, right? So let's just say there's 30 to 35 million of value that we didn't model. That has to be discounted back because it's over time. But the overage was 4 million and the interest expense was 2 million because we modeled a year and a half ago interest rates that are lower than they are now. So, just to do the math, if you have 30 to 35 million of value, but you have to subtract out, 6 or 7 and discount it, that's what he's looking at. And that's exactly what's happening. So interest rates are going up, construction costs are going up, rents are going up, and the net of that is it's extraordinarily good for us in total. In terms of interest rates, one of the things we're doing that I don't know our competitors are, they might be, they might not be, it's a good question to ask, is we're hedging them, right? So we believe that what we're doing has a really high margin. And because of that belief, I want to hedge things I can't control, right? So we're doing swaps, we're doing swaptions. I've done a whole webinar on swaps and swaptions. So if you're interested in what those are and taking a deeper dive, please go to our education section and you can watch a whole hour on what that is. But basically what I'm doing is locking in not just the construction, because we borrow at variable rates, but also the whole period up to 10 years. I'm locking in long-term rates at, by the way, still historically low interest rates. I know it feels expensive when they go from 1 to 2.5, but the reality is 2.5 is low. And I want to lock it in at 2.5 because we build to a really high margin. We believe in our ability to operate. I want to hedge the things that I can't control. I'm going to move on. So there's a question about a recommended portfolio percentage. I know that hypothetically in the presentation, we went over replacing a 60-40 portfolio with a 50-30-20. The reality is I'm not an investment advisor and I don't want to make recommendations like that. I can tell you that we've had both internal and external studies done of what the optimal portfolio would be. And we haven't shared and published it because it recommends a really high real estate allocation. And I'm not comfortable being in that role. I'm not an investment advisor. I can just tell you that I've presented a lot of data. You should look at it and be your own judge of what you think is appropriate in your portfolio. I think 50-30-20 is a reasonable place to start. But you could also look at Svensson's portfolio. He was more like 10, but he had a lot of other alts in it, hedge funds, venture capital, private equity that were serving similar alternative investments in his portfolio. I have a question about how private investments are valued and calculated. It's a good question. We have a formal process for evaluating every fund. Some are evaluated on a quarterly basis, some are evaluated on a monthly basis. For example, because Income Plus is open-ended, meaning it raises money in perpetuity, people can stay in for perpetuity, they can get out if they want. We need to have a monthly valuation to roll into a share price where those things can happen, where someone can get in or get out. Other funds that are closed-ended funds, like a Growth Fund 4, that would be done on a quarterly basis. And then all of our funds are audited. And when they audit, they're not just auditing our cash management, our risk management, but they're also auditing our valuation process. And so we have to comply with their GAAP standards there as well. Question here, at what yield do you believe in the risk-free rate, multifamily cap rates, essentially valuations would be affected? That's a great question. Cap rates so far haven't moved at all, which is interesting. Usually cap rates tend to track the risk-free rate a little bit, certainly the borrowing rate. I touched on this before, that affects the discount rate. The reason it hasn't happened is if you look at any formula for perpetuity, it's some iteration, whether you're at Booth or MIT or Harvard, the professor might have slight differences, but it usually is the numerator is earnings, parentheses 1 plus G, where G is growth, and the denominator is WACC, which is your weighted average cost of capital minus G. And the reason I'm telling you this is G, which is growth, in our world is rent growth. And as long as rent growth is high, cap rates won't go up because it is increasing your expected EBITDA and it's decreasing your denominator at the same time. And so it's very powerful as long as rent growth is high. So I would tell you, I don't know the future, what rent growth will be in 3 months, 2 years, etc. But I will tell you that I agree with you that over time, rent growth should normalize into a historical place. And if at that time interest rates are still going up, cap rates should go up at that point. That's not happening now. And I can tell you we're selling assets for Fund 3. The asset pricing is really high still. We sold an asset in Denver that's closing in a month. We're under contract in Dallas. We're in discussions this week with a whole list of buyers on an asset in Atlanta. So if you're in Fund 3, we're selling assets at record pricing right now. We haven't seen it, and it's because of growth in rent or G. But I don't know the future of rent growth. I can tell you that my opinion is that affordability ratios will eventually cap the ability to raise rents at these high levels. But I don't know that the risk-free rate will stay at these levels either, right? So that's up for you to ponder. Related question, are we in a real estate and rental rate bubble? What are the risks of correction, devaluation, etc.? I do think that valuations are fully priced. Is it a bubble? Probably not, because there's such a supply-demand imbalance for sale housing and rental housing. So it's hard to call something a bubble that's in high demand and will be for years to come. Is real estate immune to a correction? No, it's not. It could happen. I think it would be a shallow correction, but I'm making assumptions when I say that. I'm making assumptions about the growth of the economy, the growth of rent, and interest rates. Do you believe that interest rates are going to go from 3 to 10%? That would be bad for real estate eventually. It would be really bad for stocks, right? And we've seen what that can do there. So like you as an investor you have to make these decisions. I will just tell you that one mistake made by investors is not investing. The way you can ensure that you won't have the wealth that you need in 5 years, 10 years, 20 years, is to get scared and go into cash, because that doesn't yield enough to keep up with inflation, and you lose slowly over time. So, historically stocks have generated 8 to 9%. So is real estate. I think you want to be in those asset classes as a long-term investor. If you don't have a long investment horizon, you're maybe 75, 80 years old, and you have to invest much more defensively, because I don't know what will happen in the next 2 years, but I think in the next 10 years, you'll be happy that you're in risk assets. Question about what's more favorable, investing in new built housing or existing. In my opinion, it's much more advantageous to invest in development or new housing than existing. And the reason for that is the margins on development are very, very high. I've been doing this quite a while. I believe we have development in 5 funds now, so it straddles, 8 years of work, over $1 billion in development, and I've never seen margins as high as they are now. So even with building costs being volatile and generally going higher, land costs going up, interest rates going up, people focus there, but what they forget is rents are going up faster than all of that. And so the total margin is all of that together, plus the cap rate and the terminal capitalized value discounted back. We're generally developing to a 40%. I usually use a range, but I'll say 35 to 45% margin. 5 years ago, when I was developing, it was more like 30%. So if you think about going from a 30 to a 40, that's a 30% increase in the margin of what we're doing. So I really like development over buying existing assets right now. And that's why, if you look at our funds, Income Plus has development in it. Growth Fund 4 is solely a development fund. QOZ 1 and 2 are development funds. That's not by accident. That's because we see the most value in that space. I think I'm going to move. I just want to make sure. There's a question about 1031 exchanges. We don't facilitate 1031 exchanges here. We only have funds. So if you want to invest in a fund, you come to Origin. We don't provide individual deals. That's what a 1031 exchange would need to have. But we get that question a lot because we have so many investment partners. So I understand your need. The QOZ fund is a substitute good for a 1031 exchange. So if you have a piece of real estate that produced a large capital gain, you can move that capital gain into the QOZ fund. That would make a lot of sense as a substitute for 1031. And then you would get 10 investments of high quality multifamily, diversified in different cities, not one asset somewhere. So I think that's a better choice. I think I'm going to move. There's one question about IRAs. So the question is, can we invest via IRAs into your funds? The question calls it the platform, but I want to specify you invest in one fund. You can invest in all 4, but you invest in the funds. Yes, you can invest via an IRA into any of our funds. You wouldn't want to invest as an IRA in certain funds because they're so tax efficient. Income Plus is so tax efficient, you wouldn't want to waste your IRA, which is also tax efficient, on that investment. You would want to put it in the multifamily credit fund because that's less tax efficient. QOZ is incredibly tax efficient. You wouldn't want to do it there because you don't pay taxes at all. So you're wasting the benefit of the IRA. But yeah, we're approved. And there's a process. We've been doing it for a long, long time. So it's very easy to do. All right, I'm going to move to live questions, and you'll know it's live because I'm going to call out your name. So Lily, thank you for your question. I'm just going straight down here. Given the recent historical growth, there are a lot of developers developing multifamily. There's increase in supply costs. What do you think expected returns can be given all these things? Lily, I think I've answered this. The margins have never been higher. I like to, cite ranges, but if you think about the models that we run, we don't trend our rents during development, but rents are growing, right? So essentially I'm taking rents today. I don't move them up for 2 years, or longer. Some developments take longer than that. We drift our cap rate by 2% a year. So if we think the starting cap rate today is 4, that means, in a 5-year model, we're exiting at a 4.4 cap. We don't know where cap rates will be in 5 years. They could be at 4, they could be lower, they could be higher. Our models are assuming, that they go up quite a bit. And so there's a lot of conservatism in our model, and that's why we tend to overproduce what we have underwritten. And I would just kind of cite that as a theme. Income plus, if you look at our PPM and marketing, we're targeting a 9 to 11% net return, but it's returned 22% in the last 12 months. Our developments have returned over 25% historically, but that's not what we're representing. We try to over deliver. I think, Lily, that I feel really, really good and confident about where we are now. And what you're saying isn't wrong, but I think I've covered why there's still a high margin. It's because of the rent growth. I am going to move to Kareem, and I apologize. I hope I pronounced that right. Thank you for your question. He's talking about the difference between income plus returning in the last 12 months, 22%, and then the next slide says 5.7%. The 5.7%, Kareem, is the dividend, and the 22% is the dividend plus the appreciation of the assets. So we had a lot of asset appreciation. That's what it means to be in an inflationary environment last year. Assets went up in value a lot. I think you see that. If you live in Phoenix or Tampa Bay, these are markets we're in. Charlotte, Denver, Austin. The price of housing is up a lot, whether it's rents, residential homes, and our fund benefited from that as well. We also have preferred equity investments that accrue. And so if they're accruing at a 13% rate, you're not getting a dividend, it's accruing, but you are getting the 13% return. So there's a lot of things that go into that, but the short answer is 5.7 is the dividend. And then just doing the math, 16.3% would be the appreciation element. And that should make sense to you. Stocks are the same way. If you have a dividend paying stock, it's your total return is the dividend plus the appreciation of the stock value. No different with income plus. Will we be sending a recording of this webinar? I hope so. I think we record all of our webinars and we put them on our website. If you want to have it emailed to you, I can check with our marketing team, and I'll follow up. I don't see why not. Bella, thank you. Great presentation. I appreciate it. Thanks for the feedback. This is anonymous. Are you seeing any increase in multifamily cap rates yet, or is the high rent growth? I think I covered this extensively. The answer is no, I'm not seeing it yet. I wouldn't be surprised if there was if the risk-free rate stays as high or goes higher. I think cap rates should start to go up. If rents are still going up, it will net itself out. So if you think about if you raise EBITDA or NOI, but you lower the multiple on EBITDA, that would be our cap rates going up. The net is probably no change in asset value, but a higher dividend, right? Because a higher EBITDA produces a higher dividend. But the short answer is I'm not seeing cap rates going up yet. And we have a lot of our own personal asset sales that are happening right now that I can point to, but I will keep you informed. We're constantly buying and selling. Some of our funds need to liquidate assets, so we'll we'll keep you informed there. Do you need to fill out any special form of tax reporting? Each fund is different. We try to make it as simple as possible. We try to make it composite. If you elect to be part of the composite return, you get one K1, not multiple states. That's up to you as an investor. But all of our funds are partnerships. And so you get K1s. Do you see projected returns compressing in the next 2 to 3 years? I would say, this is from Arjun. Thanks for that. I would say it depends on the fund. If you're talking about equity investments, I would think expected equity returns should be slightly lower because they were so high in the last 2 years. If you're talking about preferred and debt investments, that's, income plus as an element of that, multifamily credit. I would say those returns are much safer in the capital structure. I would expect those to stay about the same. Kareem, another question. With interest rates going up, mortgages will become unaffordable, reduce the demand for sale housing. Reduce the demand for rentals in the development fund. Kareem, I'm not really sure what you're asking. If you're asking, I think I covered, if you can't afford a house, you become a renter, that increases our demand. If you're saying that if rents go up, less people can afford them, I actually agree with that. That's why I said earlier, I think that we can't have 15% rent growth in perpetuity unless wages are growing too by much higher than they are. So I would predict that rent growth normalizes. And by the way, that's what we model. There's not a single model. We have 15 developments going right now for different funds. There's not a single model that predicts more than 3% rent growth, and we don't trend in years 1 and 2. So like over a 5-year, we're actually averaging 1.5 rent growth, right? So our models are incredibly conservative because I actually agree with you. You can't grow rents by 15% in perpetuity. That doesn't work. And by the way, I would challenge you. This is another thing back to manager selection. You need to get in the weeds. You need to ask these questions. What did you do to hedge interest rates? How do you model? What you have to ask these questions to get an understanding of how they view risk and how much risk you're taking. Because anyone can show you a high return and expected value return. But what does that even mean if you don't know the inputs or how they got there? For example, if I didn't drift our cap rates over a 5-year hold, I could show you 25% returns. It's totally defensible, but I do drift our cap rates because I think that's a better way to view the world and manage risk. So if I'm showing you 16 and someone's showing you 25, and that's the difference, it's the same thing. There is no difference, right? But you have to get in the weeds to understand that their 25 is our 16. It's equal. If they're trending rents and I'm not, that's the difference between a 35 and a 16, right? You have to get in the weeds. This is from Cynthia. What areas are you developing in? I'm in the middle of Tennessee. I'd like to invest here. Cynthia, we're heavily investing in Nashville, but that's our only market in Tennessee. So in our Income Plus fund, we're investing in development in Growth Fund 4. In QOZ2, we have what I believe is one of the best development sites in the country, which is essentially in the Gulch right on the highway. It's the old Beeman auto site. We'll be doing 720 units there. So we're heavily investing in Nashville, but not in other areas of Tennessee. And one of the reasons I should tell you is when we're looking at places to invest, one of the things we look at is the depth of the market, both in population growth, but also how liquid it is in terms of capital, institutional capital, foreign capital. domestic capital, and we invest in very liquid markets. We don't invest in small areas or small MSAs for that reason. And then the last question, what is your outlook on construction costs? How is it changing strategy? Well, one of the ways it's changing strategy is we're extraordinarily proactive about trying to mitigate construction uncertainty. In the same way that I said I want to lock in interest rates, I also want to lock in construction costs as early as I can, because that's a risk I can't control and the margins are very high. So I want to try to lock in. And so we're figuring out ways to buy lumber and appliances early and store them. We're trying to get to GMP or general maximum price contract as soon as we can. Of course, you need pretty mature plan sets to do that. So, we're trying to speed up that process too. In terms of outlook, I believe it's countercyclical. So in other words, the reason construction costs, there's a few reasons. One is supply chain. But the other reason is housing is hot because there's an imbalance, right? There's a need for housing, both for sale and rental. People are trying to build it to fulfill it. And in doing so, you have a lot of demand for goods. If there were a recession, or if interest rates make one segment of housing less affordable. So like, for example, when we get off the webinar, pull up all the publicly traded builders, home builders, stocks, and mortgage companies. They're all down 30% this year. Why? Well, because interest rates are higher, and the belief is no one's going to refi, because why would you refi at a higher rate? So that kills the mortgage industry, and no one's going to be able to afford a new home. So that's going to kill the housing industry. What that does for us is it actually removes demand for these goods, right? So if a builder's building less for sale because they believe there's less buyers because it's less affordable, that means my cost of lumber should be coming down because my competitor, that product, is building less. And so I believe it's countercyclical. Like as rates go up or a recession hits, you're going to wind up with lower rent growth. That's bad for me and us, our partners, but it's good in the sense that building costs should be coming down. And that's what you see in recession and slowdowns is it's a really good time to build from a building cost standpoint, but you're also having to build into lower expected rents because those should be flattening as well. Last question, and I'm only 13 minutes over. So if you've stuck with us, we measure everything. So there were 500 of you investment partners or potential investment partners in the beginning. I'll let you know later how many made it this whole time, which will be interesting. Why don't we invest in California? Is it the high state tax rate? It's really affordability. That's the reason. And it's also population flows. They're interrelated. California loses population, domestic, every year. It's kind of a flat state because they actually attract foreign citizens and immigration. So it tends to be kind of flat. Illinois is worse. We have net outflows because we don't really get the international and the domestic leaves. So I don't like to be in negative growth states. I don't like to be in states that have really high cost of living. I think it's hard to raise rents when they're already really high. So we look at lots of things. We haven't talked about our machine learning and our AI, but we've been building it for years now. We have data scientists here at Origin that live and breathe this stuff. But essentially, our city selection model is based on 3 billion pieces of data that comes in a month. We have our own opinions, but we also have unbiased data. And it's, California is not a bad state, but I would say it's middle of the pack and nowhere near to the amount of expected growth that we see in the states we are in. But it's far better than Illinois, which is bottom rung. And so we're a Chicago-based company that doesn't invest in Chicago. It's kind of interesting. Well, thank you for your time. I have answered all the questions, the live ones. If I didn't get to your emailed in one, I apologize. You can always email me at david@origininvestments.com. I hope that you learned something today. And if you remember, if you didn't find something clear, that's my fault. That means that I didn't explain it as well as I can. And I know that we can clarify these things. So reach out to us. We believe the most educated investor will ultimately choose to partner with us. So have a great day.